Tuesday, March 29th, and another market update. Can everybody hear me okay? Can you just type in and let me know what's going on? Okay, very good. So we're going to proceed. So what you got going on right now is the market's come straight up off the bottom of a 2600 on the NASDAQ. You can see the chart of the NASDAQ index in front of you here on my screen, and you can see that we've been coming up straight up off the bottom. We had a follow-through day on Thursday because the NASDAQ index was up 1.41%. I do want to do one thing here before we start. I do want to throw this up here. And just let you know that.
Excuse me, Gil. I cannot see your screen.
I can't see your screen either.
Can't see screen. Okay. How about now? Can anybody see the screen? You see a title screen?
Yes.
Much better.
Yes.
Okay, so we've got to do a little legalese here. So the information contained herein is not and should not be construed as an offer to sell, or this is a solicitation of an offer to buy any securities. In other words, we're not telling you what to buy or sell. We're just kind of giving you some insight into what we're thinking right now in the market. Remember, these are not rehearsed or polished presentations. It's real time. We're coming to you right after the close. We're going to talk about what we're seeing right now in the market. So the information that we have here is obtained from sources which we believe to be reliable. However, these sources cannot be guaranteed as to their accuracy or completeness. The information and content expressed herein are subject to change without notice, although you may get an email on the Virtue of Selfish Investing website. And Mocha Investors LLC and or its employees may from time to time have long or short positions or may acquire direct or indirect beneficial interest in securities mentioned. So that's what a law degree gets you. You get to write stuff like this. Anyways, getting back to the market, you can see that we've come straight up off the lows here from 2600. Okay, we had a follow-through day on Thursday, and this is somewhat controversial. And I know people like to be doubting Thomas's and wonder why it's 1.4 when it's been 1.5. And if you recall, back in the old days, back in the 90s when the market was less volatile, follow-through days only had to be up 1% on one of the major market indexes. And back then it could have been the NASDAQ, the S&P, or the Dow. Chris does real-time analysis of the market. When we were at O'Neill, I frequently would assign him the research project of looking into the current market data and doing a basic optimization solution, or finding a basic optimization solution fitting the data to come up with the most optimal follow-through percentage move required for a follow-through, okay, or also known as a threshold level. And his work is beyond reproach as far as I'm concerned. And if he says 1.4% on the NASDAQ is good enough for follow-through, then we're going to go with it. And of course, you've had a buy signal on the model as of Thursday, and of course, the market is higher. Okay. Now, just because you have a follow-through day doesn't mean that you're starting a big, bold, new rally phase. It does mean that you should be on the lookout for things on the long side, and it also means that you're probably not going to make any money on the short side. Now, I know last time we had our little webinar meeting last Tuesday, I said that I would probably do a weekend webinar on short selling. And of course, I thought about this a little bit and looked at what was going on in the market on Thursday in terms of this follow-through, and I decided I didn't want to go ahead and do that because I didn't want everybody to start thinking they need to start shorting the market. And that's usually what happens. You have a short sale webinar and everybody now looks at everything bearishly and they may start doing the right thing. And my sense was over the weekend that you're probably not in a very good position to be making money on the short side. Not yet, at least, unless the market starts to fail. In the meantime, there are some names that have been working on the long side, and of course we've sent out some alerts for stocks like Molly Corp, which have done pretty well. But today you had an outside reversal. Volume's pretty light. I think you were just a little bit above. Chris, were you just a little bit above on the NASDAQ today?
Let me see. On the 30-minute bars, or rather the 60-minute bars, it looks like, according to eSignal, we're a little bit lower than yesterday.
On the NASDAQ, okay. And
yeah,
we're looking at...
a hair lower. And on the S&P, we're a hair higher on the S&P.
Yeah, and IBD is actually showing a little less. You're a little more on the S&P, so you had a little more volume today on the S&P index. So you're trying to come out of this basically, and right now a lot of people are looking at the market and thinking that breadth isn't that great and not really that enthusiastic. And I got to tell you, I don't get that enthusiastic either. It's a little bit of a grind, and you have to sit through some intraday volatility. But things do sort of work their way higher, and you did have this outside reversal day. You're back above the 50 days, so this rally hasn't failed yet. And as far as I can see, it wants to go higher. At least it looks like it does. Chris, what's your thought on that?
Well, it's a good formation when you have a reversal day like this to the upside, closing at the high. The volume, it would have been nice to see stronger volume on a day like today, but it did clear the 50-day, the NASDAQ, and the other averages look constructive to me as well. So, S&P, of course, is being more constructive because the volume was slightly higher. But we're splitting hairs. I think the formation overall over the last few days since the follow-through day was since the buy signal was issued looks about where I would like to see it. And incidentally, that 1.4% clearance on the Nasdaq is on the basis of the average true range of the index itself. So in other words, the follow-through threshold percentage required is based on what the ATR is of an index over a span of time. And so that number can change. In practice, I don't like to change it very often because I don't want to be guilty of overfitting the curve, so to speak. So the changes of these threshold percentages are rare occasions.
But you have had one, and right now we're looking at 1.4% on the NASDAQ would be good enough for a follow-through. And I think we've done reasonably well in terms of picking off stocks that are looking pretty good. I mean, we did just switch back to Molycorp. We told you about the pocket pivot coming up here, and that was a beautiful position to come into on this one. It's very volatile, hard to trade. Now, you run up pretty quickly. I would look possibly you're in a cup sort of pattern now. I wouldn't call this a double bottom. If it is, it's probably improper because the second low here has not undercut this low. But then that doesn't have to be a problem if you set up here in a cup sort of formation and then form a handle. And some of the patterns seem to argue for more work needing to be done, which could mean you're in a sort of a choppy environment here as the market really doesn't slam to the upside. But it could. So I think you might want to be long a few things. So we've been putting some names in the portfolio simulator. And of course, Oracle, I think, is an appropriate name for this environment because of the fact that it's fundamentally very sound. It's a big leading stock. They're exposed to the cloud computing area, and they're huge in that area. And they're actually the original cloud computing stock. If everybody remembers, I've talked about this before. Larry Ellison, the CEO, back in the 90s, postulated the network computer, or the NC, where you had all your applications and data off the not on the computer rather, but accessible through a network. And so it's a steady stock. You had a pocket pivot here, and I really don't have a problem with this sort of pocket pivot as long as it can pull in constructively and then hold the 50-day. Now, Dr. K, what's your take on something like that?
Sorry, say that again. You were coming in jarred.
On Oracle, we see that we had a pocket pivot type move on last Friday, and it closed at the low end of the range. Is that not any less of a pocket pivot, or do you consider it a
well, I would be a little wary about that because it did close at the low. It still is a gap up, and so you have that space there. So that's positive for it. On balance, it does qualify as a pocket pivot, but just barely.
Right. And because you're in a big cap name, this may very well work. It's not a real high octane name. And the other thing is you come straight up off the bottom, so it does stand to reason that you are going to have some overhead come into play. So I'm interested to see how this settles in here along the 50-day. It could go sideways for a while, but we do have a 12.5% position in the portfolio simulator, and I think it's reasonable. Doesn't mean it has to work, but the other thing is we can use a 50-day moving average as our guide for a stop, and that keeps us pretty near to where we want to get stopped out if it doesn't work. So the other thing that we've been looking at is Fortinet, and we had some questions about this. Some people get nervous because it's a 78 PE stock, but just P's are not relevant. P's are more a measure of how the market values the earnings stream of a particular company. So in this case, the market looks at Fortinet and it values its earnings stream at 78 times. And so that's telling you something about what the market thinks of it. The other thing is the price volume action tells you everything you need to know, so you don't really need to overanalyze it and get yourself all worked up over the possibility that the PE is too high. We know that big winning stocks can have huge moves even as their PEs get to be 100 to 200, and a lot of leading stocks actually do that. But the thing with Fortinet is that if you look at a weekly chart, let me see if I can find my weekly chart in here. I always tend to lose these things. And of course I did. There it is. I'm just going to get rid of these. Now you can see on the weekly chart of Fortinet, it's been moving up, and it moves up a little bit, and it goes sideways, moves up a little bit. And it's been doing this as the market has been very weak since January. So if we come over here from early January, right about here, you can see that it's been moving up, and the market has actually been rolling in this big rolling sort of pattern as this has been moving up. Now, one thing that Bill O'Neill taught me back when I used to work for him was that a lot of times they'll have a stock, and during a fuzzy market period, it won't necessarily form an ascending base, but it will do this little stair-step pattern where it goes sideways for about 3 weeks, 4 weeks, and then moves up a little bit, and then does it again for 3, 4 weeks, goes sideways, and then moves up again. And what it essentially does, it just gets everybody bored with the stock. I know I've gotten bored with Fortinet more than a few times, and we've pulled it off and gotten shaken out a couple of times. Not at huge losses, but it does tend to do that. But what happens is it sets up the psychology here to surprise the crowd, and potentially if the market turns and gets some more power, I think the stock could go considerably higher. They are the leader in what's called unified threat management, which is the fastest growing area of network security right now. And so on the daily chart, you can see that the stock picked up a little bit of volume today, and it's coming up above the 20-day moving average and the 10-day moving average. So it's acting okay. So we have a little position here, 12.5% as far as the portfolio simulator goes. There's nothing to get too excited about. But it does mean we're getting our feet wet here, and we'll see how things pan out. The other position in there is gold on the DGP, which is a 2 times gold ETF, and this is just kind of futzing around, not really going anywhere. You're in a nice consolidation. It's reasonable consolidation. You could pull back and test the 50-day moving average back here, which is the blue moving average. The black one is a 65-day exponential, and so you could eventually break out here, and I'd actually be watching for that. But we have a position in DGP kind of hanging out. Dr. K, any take on gold right now in your view versus silver, for example, which is the other position? Yeah.
Silver tends to be 2 to 4 times as volatile as gold, but they do track in the same direction in general. So. I mean, we have positions in both of them, and I think as the central banks around the world continue to devalue their currency with the Federal Reserve at the forefront of this, I think that bodes very well for these precious metals. The Greenspan's next talk in early April, I think, will be important because he'll give some indication about the future of quantitative easing, since it's ending in June. So all ears are going to be on Bernanke, rather.
Bernanke, not Greenspan. There you go.
Yeah, well, they all look the same to me.
So they all talk the same too, and I think they all screw up the same way too. But I think Bernanke's been a lot more, shall we say, effluvious about spewing liquidity into the market, and of course that's what's led to QE. But yeah, from a tactical standpoint, I pointed out last week that silver, when it trends, and you notice when it trended here, I hope my charts aren't too slow. If they are, a holler. When silver started trending up to $20 on the SLV, notice the 20-day, the green line, the green moving average, served as pretty good support. Once it violated that, it went to a consolidation. Then you can come back and start re-entering on the breakout here. Now, recently on the Japan news, which is a couple of weeks ago, actually a little more than that, silver broke down. The idea being that people have to liquidate commodities, or Japan's going to create some sort of a demand gap for commodities, and a lot of them did pull back. But it held the 20-day. It did not violate it, so it's still holding true to form. That when it starts to trend, it holds the 20-day. And you ran up. You had this big volume move. But you have to remember, commodities are volatile. Silver, as Dr. K said, is 2 to 4 times as volatile as gold. And it just in and of itself, it tends to be volatile. And so having these reversals, we've seen them occur before, and they don't really seem to amount to anything. This thing pulls in a little bit, silver pulls in a little bit, and here you notice this is probably one of the more constructive pullbacks. It's settled in here after this big reversal. So just because you see a one-day reversal doesn't mean silver's topped. And we do get emails from people asking us, does this mean silver is topped? And no, we don't think so. I actually think silver has a long way to go. I've been invited to be on the Stuart Varney show on Fox Business News on Friday morning at 6:45 a.m., 15 minutes after the close here at Pacific time. So anybody watching Fox Business News Friday morning can catch me. And Stuart wants to talk about silver, and he wants to talk about the California budget crisis and the U.S. fiscal crisis and how this all ties together. My view is that if you do the math, there's really no way that we're going to pay off our debt. I think that given the magnitude of the debt now, George Bush over 8 years ran up $2.5 trillion in deficits, and I thought that was crazy. And Barack Obama, though, has managed to outdo George Bush. In 3 years, he's got $3.5 trillion. So we're looking at a $1.65 trillion deficit this year. Now let's think about this. If you're trying to pay down your debt and your economy is growing at 2 or 3%, you're going to get into a lot of trouble if you're rolling over this debt constantly, which we do, and interest rates start to rise. And if interest rates start to rise above your economic rate of growth, then you're getting to a position where your debt is rising much faster than your economy can grow its way out of it. And so I think they've got two choices, and that is going to be default or devalue. The U.S. is not going to default because unlike Greece or Portugal and the other European pig countries, our debt in the U.S. Is denominated in dollars, not in another currency. So we can print all the dollars we want and basically monetize the debt by doing so. And I think that's where they're headed. And you may notice that when the Treasury Secretary Geithner talks and when other U.S. government officials talk, they never ever mention that we would devalue the dollar for the purpose of monetizing the debt. The language that they use, and I notice they're very careful about this, says they say they would never ever devalue the dollar for the purpose of gaining a trade advantage. Well, of course not, but they probably would do it to monetize the debt. And despite their assurances to the contrary, that is in fact what they're doing. And so my view is that you're going to continue to see the dollar devalue. I believe Dr. K agrees with me, yes?
Yeah, I mean, it's lying by omission. I mean, that's effectively what they're doing, like good politicians should.
Yeah, so what happens now is, paper money, and historically, paper money that's just paper, historically it tends to return to its intrinsic value, which in the value of paper is pretty close to zero. So over time, I think you're going to see people looking for alternative currencies and alternative money. Okay, China continues to accumulate gold and silver, and my view is that they are probably looking at, and you can listen to what they say when they say that they don't see the dollar continuing its role as a reserve currency, a global reserve currency, and that it's going to become a thing of the past. And they can say that probably with confidence because I believe that they're working diligently to let or to create a situation where their currency, the renminbi or the yuan, whatever you want to call it, becomes the global currency, reserve currency of choice. And what they are doing is buying silver and gold, and what they will do when they make that move is that they will back their currency with silver and gold. That's what I think is going to happen, because then that really puts it to the U.S. and puts their currency in the dominant position.
Yeah.
Globally.
And this could happen over the next, sooner than people think. This transition could be within the next couple of years. Effectively, what China's facing right now is an inflation problem. And they have a huge growth rate. The actual underlying growth rate is about 15%. So, if you're growing at that rate, you don't want to lend your capital out. You want to keep borrowing. And China wants to borrow. They don't want to lend. And they need to do something, though, to mitigate this inflation that's been increasing. They've been doing things like hiking rates. They've been increasing the bank reserve requirements. but that's not going to prove enough to slow down or to reduce the situation of the inflation rate. So at some point, they're going to have to decouple, or maybe gradually decouple, the yuan from the U.S. dollar. And when that happens, that's going to create quite a seismic shift in things. And that point of decoupling or partial decoupling could happen within the next 18 to 24 months.
Mm-hmm. And we have to keep in mind that as we shift more to real money, in other words, silver coins, gold coins, silver actually becomes a little bit more easier to deal with because of the fact that it's the cheaper the metals and denominations would be smaller, so you'd be more likely to want to be exchanging silver coins. So I also think that over time people will consider silver to be a necessary part of their overall asset allocation matrix. In other words, normally people will have 50% stocks, 20% bonds, and 10% this and that. I think in this case you'll see people begin to see the metals, and I think even silver as a poor man's gold, become more a mainstay, a part of their asset allocation mix. So the technical action in silver, as we see in the SLV, is very strong, and so that's been one of our favorite positions and actually one of our best positions, in spite of the fact that the market is a little bit difficult outside of the indexes and a few stocks. So what I want to do now is kind of move through what we're looking at in terms of other areas of the market. So the dollar, of course, is in this downtrend, and this is consistent with what we're expecting to see. You get a break to new lows here, you undercut these lows, and now you rally back into resistance. My guess is the dollar continues lower. And I might add that if, in fact, as we believe, the U.S. government is going to continue to monetize the debt by devaluing the dollar and spraying liquidity into the system, then it could very well find its way into the stock market in the short term, and you could continue higher. So you have to kind of keep that in mind. But anyways, those are the situation with the dollar here. Looking at bonds, again, you had a rally. Remember last week we talked about this, that it looked like it was trying to form a bottom, but that would not really be consistent with the outlook that we have. And this is one case where we're sticking to a fundamental view with respect to the dollar, and of course by extrapolation the bonds as well. So we would expect bonds to be making new lows as well. So I actually had somebody come to me last week, a friend of mine who is building a hydroelectric dam, and asking if I wanted to participate in the first round of financing for this dam, and it's basically a debt issuance. So you get to you get to own debt of this dam. And I guess a hydroelectric plant would be good, but my view is you don't want to own any debt, because I think interest rates are headed higher and treasuries are headed lower. People make fun of PIMCO now because they say that they announced that they had dumped all their bonds here. I wouldn't be so quick to criticize them. I think Bill Gross knows what he's doing, and you will soon see whether he's right or not. My guess is that he's going to turn out to be quite right. So that's what we're seeing there. Now, as far as stocks go, Dr. K, what's your favorite stock right now?
Actually, before we go to that, I wanted to say one more thing about the follow-through day, rather the buy signal. That's the more accurate representation, because you can have a follow-through day without a buy signal. And I actually illustrated this to the Canceling group because they were wondering why the model would go to a buy signal on a day when the NASDAQ was only up 1.41%. Well, two reasons. First of all, 1.4% is the threshold level, but let's say that the NASDAQ was only up 1.3% that day. It still would have gone to a buy signal, simply because there's other factors that go into the model. The model is not black box, but it remains flexible to changing conditions. And essentially, when there is a factor that changes materially, that affects the market for more than a few months, then it becomes a rule in the model. So the most recent case would be when quantitative easing began in March of 2009. By later 2009, we could see that quantitative easing was a very formidable force in the direction of the market. So it eventually became a rule in the model. So therefore, even if we fail to meet that threshold level, given everything else, plus the factor of QE, the model still would be on a buy signal. Now, as far as my favorite stock right now, Well, I mean, I'm a big I really love gold and silver. So in terms of stocks, it would probably be something in that area. I mean, the only thing I really like actually in gold and silver right now are the ETFs, the ETNs, those instruments. So AGQ and DGP. And as far as individual names, there's a few good ones out there. I mean, there's GMCR. That's looking great. That had a change in its fortune on that gap up on that news event, and I think it could go a whole lot higher from here. Certainly, the price volume action is indicating that. And there's a few others that look very healthy. I mean, Priceline was very tight. It didn't correct nearly as sharply as the overall markets. It gained support at the 50-day, like it's done since really August of last year. So that one looks very healthy as well. And it's what I like also about the pattern is that it's a very tight pattern, so you have, in a way, less risk associated with this kind of pattern.
Anything else?
Well, oh yeah, the other thing related to the buy signal on the model, a question came up: why didn't I recommend TQQQ? And that's simply because Apple, which was certainly a leading stock and possibly still is, it did break through. It did have a break through the 50-day on volume, and the pattern is not looking as robust as it used to. And since TQQQ, 20% of Apple is weighed in on the Nasdaq 100, and TQQQ is 3 times the Nasdaq 100. Therefore, at this time, it's not wise to recommend the Qs or anything related to the Nasdaq 100, since if Apple gets dragged down, it'll artificially drag down that type of ETF.
Something I might point out, though, to kind of argue the point with you just a little bit on Apple, and that is that you've seen a lot of heavy selling come into the stock. In other words, you see these waves of selling. You have one wave of selling here, you have another wave of selling here, and then you have a third wave of selling here. And now, none of this has served to knock the stock down. In other words, you've had a lot of selling hit the stock, but it really hasn't broken down. It got below its 50-day, now we're back above it. I might argue that you may have just gone through a process of shaking out a lot of weak hands in the stock, and you may be setting the stock up to either base further, perhaps it gets more constructive, and then it could turn and go higher, which then would bring the Qs back, the TQQQ, back into play. So what's your take on that argument?
Well, on that argument, I would say, first of all, it's one of the most widely followed institutional stocks. Therefore, should the market go higher, it's going to track higher with the rest of the market. It might even outperform the rest of the market. And then if it does so, and it's out of the woods, so to speak, then certainly TQQQ is a viable recommendation, once again, because now Apple has reasserted its leadership. Where it's at right now in the pattern, I would still say it's kind of in no man's land. It needs to show some leadership once again, and basically get through this area of congestion. Then I'll feel much more comfortable with it.
So would you take a pocket pivot here? I guess you'd have to have volume higher than this one over here, which is not likely. But maybe this occurs over several more days. You set up sideways and see a pocket pivot. That would probably be your first inkling that this is gaining strength. Yes?
We need time. The pattern needs time, and therefore, over a number of days, if the pattern were to get tight and constructive and then issue a pocket pivot, I believe, I think we should send out a report to our members, notifying them that Apple has had a bona fide pocket pivot. But right now, it's still a little bit raw.
Okay. Now, in the meantime, what do you think is the best ETF? And I'm just going to pick 1x or 2x in terms of playing your buy signal on the model as of Thursday last week.
Oh well, I would say in terms of appreciation potential, probably AGQ, because it's silver, it's very volatile. It's in this latest run, it's up to 4 times as volatile to the upside as gold is. So that one is certainly viable. There is also IWM. That's a one times ETF on the Russell 1000. Essentially, when you have a buy signal, going back, you can go back a year. You can go back to actually since QE began, March of 2009, and we actually published up on the website the results is by following the model's buy, sell, and cash signals on TNA, Tom Nancy Apple, and that's the 3 times Russell 2000 ETF, and it actually showed the best performance over any of these 3 times ETFs. It certainly beat out TYH. So that was another recommendation we made in this latest buy signal, was to buy anything related to the Russell 2000. It tends to move the furthest, but also when the market corrects, it tends to correct the most as well. So the obverse of TNA is TZA. So to buy TZA on a sell signal would also make sense, and that's why the TNA TZA vehicle has outperformed since March of 2002.
I would note also, if you look at a chart of the IWM, it looks fairly constructive and actually a lot better than the NASDAQ, the TQQQ, which is in a much lower position. So that may be one of the better index ones to play then, in your view.
That's right.
Okay. We looked at MCP, so we're going to go through a few stocks. We gave you the pocket pivot here. It's continuing higher. Now look for this to form a handle, so it may need to go sideways for a little while. If it came straight out to new highs, that could be a problem. Today, JP Morgan came out and raised their price target somewhere to 70 or 80 bucks. I don't know. They're actually my prime broker, but they never tell me anything, so I had no idea they were going to do this yesterday or anything. Not that they do that sort of thing, but I didn't hear about it until I saw it in Bloomberg News. In any case, stock's coming up to the highs, and I would look for it to form a handle. As I pointed out earlier, this is not a proper double bottom, but it doesn't have to be. It could just turn out to be kind of a funky-looking cup-type formation. You form a handle up here, and then you go higher. But rare earth metals seem to be the thing to be looking at right now. RE is a lower quality play. It had another pocket pivot today off the 50-day moving average. This may go higher too. Tough to call, but MCP is clearly the higher quality leader in the space. But you did have a pocket pivot here. We didn't put out a pocket pivot review email because we wanted to save it for those of you who have subscribed to the webinar service. And it is a very small group, actually, about 10% of the current subscribers, so it's a very select group so far. So we're trying to make it somewhat representative of that concept. But RE coming up on a pocket pivot, maybe this thing goes a lot higher. Maybe it's heading to 18 bucks. I do like the action in Deere. I think this is constructive. It ran up, it's corrected, and you're in about a 7-week base now. I definitely would keep an eye on this one. I like the action today. Pick up some volume off the 50-day moving average. Constructive, it may need a little more time, but I think this is definitely one to take a look at and keep an eye on. And of course, Caterpillar is the leader here, and it's continuing to move higher. You get a couple of gaps, and it's just trending higher. Now, remember, this is actually the first time, I believe, in its history Caterpillar has gone above $100. Remember the old Jesse Livermore rule from Reminiscences of a Stock Operator, when he's talking about Anaconda Copper back in 1906, I believe it was. Correct me if I'm wrong, Dr. K, but his rule was that when a stock first goes through a century mark, in other words, 100, 200, 300, 400, whatever, for the first time, it will generally continue higher and do so in a very definitive and very powerful manner. Now, the market got into some trouble as Caterpillar was first getting through 100, but it did start to do that. And then you ran into a little bit of general market trouble, but it's held its 50-day moving average, and now we're moving higher. My guess is you're going to see the stock get towards 120. If the market doesn't roll over, the market is going higher. This thing is going to be one of them that leads it higher. So I think if you own it, you definitely want to hold on to it right now, and I think you're in a decent position. This stock, at one point I actually thought Lululemon could be a short because it was bouncing along its 50-day moving average, but it did get very tight on the weekly chart. Let's see if I can get a good weekly chart in here. Let me just shrink this guy. Actually, I think this could be a daily chart. Let's go to a nice clean weekly chart. Change the interval. by the way. This is e-signal I'm using, but notice how in here you did have some tight closes. So my theory was that if the market rolled over and this thing broke its 50-day moving average, it could become a late-stage failed base, but it didn't do that. Okay, so you basically watch what's happening in real time, and I didn't take the position that it was going to do that, merely that might be something to look out for. On the other hand, if it doesn't break and holds and pops out of this base-on-base formation after showing this tight action, that's a pretty decent move. They announced a 2-for-1 stock split yesterday. Stock could pull back into the 50-day. It tends to be volatile, but so far that's been working pretty well, and I think that tells you something about the market. Another one that I thought might be similar is Chipotle Mexican Grill, but it's actually picked up some volume. Today actually was pocket pivot volume. It was a very clean pocket pivot volume signature. The only problem is you're a little bit extended from the 10-day. Dr. K, what's your take on this?
Well, yeah, it's too extended really at this level. You could buy it on constructive weakness at this point, but
Yeah.
it's too far up.
But you are clearing the low end of this range here with a pocket pivot volume signature. It'll be interesting to see how this pans out. But this is sort of a base, sunken into a base, really. This base here, between 240 and 275, is not actually above this base. It's actually sunken into it. But it's actually on top of this area. So this could work its way out, too. A lot of people look at this being overvalued. If the market goes higher, this could go considerably higher as well. And notice after hours you're seeing Apple trade up just a little bit. Oracle, I like, so far acting well. MCP we talked about. Fortinet we talked about. Netflix. Nothing wrong with Netflix. Flag the pocket pivot. Again, when it pulled back down, my suspicions were it could potentially, because you had some weak upside volume in here. You can see down in here these 2 days. Wasn't getting any support, and we theorized that if it broke the 50-day moving average on volume, like Lulu and CMG, we were watching for that in the same way, then it might become a shortable situation, but it didn't. It actually held, and you've seen volume pick up. Now you're forming this cup formation. Maybe you go sideways for a little bit here. But Netflix still has a large short interest, and so it still seems to be in play. We own it. We're sitting with it right now. And for the most part, it's a hold right now. It looks acting constructively. Nothing really to worry about in terms of the current action. It looks okay. One of the more interesting moves is this Omnivision today, which is a pocket pivot volume signature, but it's not a pocket pivot. You actually may have had one. No, you just missed here. This is a little extended. This is a very choppy formation, so this is tough to deal with, but you've broken out to new highs. A little bit frustrating. Now, some of the real strong moves have been seen in the Chinese internets. And you have to wonder with the devaluing dollar, and feel free to chime in here, Dr. K, if you have something to say about this. Chinese stocks may become favorable simply on the basis of the yuan or the renminbi rising relative to the dollar as the dollar continues to fall. And of course, if
the currencies are pegged at this time, however.
Right.
So
if that ever became decoupled, though, it could result in these stocks moving higher. Yes?
Right, and the market could anticipate that decoupling or the beginning of partial decoupling, 6 to 9 months in advance.
Yeah, and here's a nice clean breakout today in Sohu. We've seen Cena's acting very well, so that's Sohu actually would be a viable breakout here, using probably 85, 86 as potential support on this breakout here. NetEase has also been acting well. We talked about these last week, if you recall, and this is moving out to a new high. And of course, the granddaddy of them all, Baidu. Somebody told me that Baidu is outgunning Google in China because Baidu speaks Chinese better than Google does, and that's probably true. But here you have a breakout. I think a pullback towards 130 would be viable. By that time, the 10-day may catch up to the stock, and watch how it acts coming into the 10-day, because you may get a secondary buy point on a pocket pivot. Any thoughts on Baidu or any of the Chinese internets? Chris?
Well, Baidu's the leader. Baidu's the leader in the space, and it so far it looks great. We had that breakout pocket pivot coincide a few days ago. and it's a little extended up here, but I would buy this also on a constructive pullback.
Yeah, I like I'm watching here for the 10-day coming in. So somebody asked about shorting in CRM. We're going to move to answering some questions here. Is CRM still shortable? Well, my view is if we have a follow-through and we're on a buy signal, the chances of making money on the short side are not going to be that great. And you may recall in the Follow the Stock Portfolio Simulator later, we did have a short position in CRM, but I actually we notified everybody via email that the Portfolio Simulator covered somewhere in here at about 122, I believe it was, somewhere around there. And the next day you have this gap up. But you can kind of get the feel for these. It's coming down to the 200-day. That's your initial target. It's bouncing up. Now it's up into the 65-day moving average. If you're the type of person who wants to try and anticipate a market rolling over here, which I really wouldn't try to do. It doesn't mean, though, that CRM won't roll over, but I do think your chances are better if the market's going to trend higher to be long rather than short. But, you know, looking at this, it ran into some volume here. I've been messing around with it here. Actually, on Friday, I was short a wad of it, and it came in a little bit, but covered and took a little profit. And here it's messing around. This morning, actually, I was shorted again, and it came in, covered, and took a little profit. But I don't get the sense that it's really got any downside thrust. And it could eventually end up turning higher. And I'm going to point out something to think about here, is that here's your peak over here on CRM, and notice how you have one wave down here from here to here, and then you rally out. You have a second wave down from here to here, and you come up again. You have a third wave down. So this thing has had 3 waves down. My guess is this may try and turn around and go higher because it's had 3 waves down. It's getting a little bit too obvious. Now, if you look at the other cloud computing stocks on F5, which was a beautiful head and shoulders, and let me shrink this just a little bit so you can all see what I'm looking at here. Here's your shoulder, here's your big head, and of course you have the big breakdown. The right side here is the right side of the head. That defines the right side of the head and the head and shoulders. And you have a big right shoulder. And now you've broken down below the moving average. But here you have 1 wave down and you've had 2 waves down. This is much weaker, so there's always potential you could break down and have another leg down. But if the market continues to rally, I would be careful here because you are getting way down in here. You're good, what, 50% off your highs? Well, not 50%. You're about, help me out, Dr. K, 35%.
35, something like that, yeah.
Yeah, and when a stock corrects 35% off the peak and you're not in a bear market, sometimes that can kind of be it on the downside. So I was actually feeling this one out today and putting out little shorts in it just to kind of get a sense of how weak or strong it is. It doesn't strike me at all as being very weak. So I wouldn't count on making money on the short side. It is rallying back into the neckline, but a lot of times you could just consider this a bounce off the neckline, and it could actually end up going up higher into the 50-day or the 65-day exponential, which is the black line. Remember, black line I use is a 65-day exponential moving average. The blue line is the 50-day simple moving average, okay? And, of course, the magenta line, it's very faint here, is a 10-day. The green is a 20-day. And this red one here is the 200-day. So those are my colors, and that's how I set mine up. I think Dr. K is similar. But anyways, I don't think that you're just going to get a lot of mileage here. Again, you have VMware, two waves down. Yeah, maybe it has another wave down, but it might rally up into 84, 85 first and then roll over. Or it could just set up in a whole new base. So the problem with shorting is that the market goes up more than it goes down, okay? And so you'll start to look at a pattern and start to think that, oh, this looks bearish and it's going to break down. And you get yourself in a bearish frame of mind. And, yeah, this pattern looks pretty weak, okay, for lack of a better word. But I think if we're realistic here, on the weekly chart, what's really going on? You know, it's correcting here. Maybe this is a big head, but it could, you notice here as you're coming down, you try to close in the upper part of the range up here, and then you break here on some market weakness, and then you rally back up in the line. This could be building a base. You don't know. And how far down are we on BMW, Dr. K? We're only 17% off your high, so this could turn out to be a right shoulder, or it could actually build a whole new base and come out. And that's one of the reasons why I would not be so confident that CRM is going to blow apart. It's the one that has held the 200-day. It came right on top of this structure here, which you had a big gap up here this day. It doesn't show up on the weekly, but this was a big gap up on the daily chart here. And so I need to stop this from loading. So this could just set up in a base, and then again you have 1, 2, 3 waves down. A lot of times that can be a bottom in a base, and stock will turn around and fool everybody. So to answer your question about CRM, no, not as sure right now. How about this one, Dr. K? You like this one? You like the soft? You know, corn production is not going to be so high this year thanks to I don't know, rain in all the wrong places or rain in no place. Also, was reading today that 40% of the U.S. corn crop is going to be used for ethanol. So if you're wondering why your corn chips are getting more expensive, maybe that's why, because they're trying to turn it into ethanol. But Dr. K, what's your take on this right now?
Well, JJS is they're in coffee, cotton, and sugar, and they're commodity-based ETN. So I think their long-term trend is going to be up, just like for all commodities, and so I still think it's viable. It had that bounce up on a huge volume, and right now it seems to be in no man's land. But if you have a position, you could still continue to hold it, maybe use the 65-day. But again, if it's a little uncomfortable to see it gap down below the 50 and then not rally, and in fact it violated that low. So if you've sold it out, that's perfectly acceptable. But I would definitely be on the watch for constructive action. If you look at other commodity-based sectors, the big granddaddy is a Commodity Research Bureau, the CRB index, and that had a sharp pullback and then a nice bounce. So that's probably going to go a whole lot higher from these current levels. So JJS is viable.
One thing I would point out, I don't know if anybody follows Richard Wyckoff. Richard Wyckoff actually wrote the Journal of Wall Street, I believe, and he was one of the first people to interview Jesse Livermore. And a lot of reminiscences of a stockbroker has its foundations in the interviews that Richard Wyckoff conducted with Jesse Livermore. Of course, he didn't write the book, but a lot of what comes out in that was contained in those interviews. But Wyckoff has a standard issue, what I call a Wyckoфfian low, and that is when a stock comes down hard and then it gets real strong support and then it will roll over again and it'll retest this low. And the volume will dry up on the retest. It's actually something I'll watch for as potentially viable. Now, if you pull down a little bit, you might, as Dr. K said, try and buy it off the 65-day exponential moving average there. It tends to be viable, I think, on weakness rather than strength, because you notice here that's real strong, and then you get a pullback, you get to buy on weakness. Again, it gets strong, and you get a pullback. Here it gets strong, and you get a pullback. Same thing here. You break out to new highs, you get real strong, and you get a pullback. So it's not something to buy on strength, and commodities are a different animal, and we tend to take that view with silver, with the metals as well. That's why we really liked the iShares Silver Trust SLB right off the 20-day on the pullback, because we're pretty confident that that is a good reference point. So that's our take on JJS. We have some questions.
Someone asked if it trades on the basis of the supply and demand of its shares, which is not correct, because ETNs and ETFs. The markets are made differently. In other words, if you were to buy,
you're talking about JJS, right?
Yeah, if you were to buy a huge amount of shares of any of these ETFs, well beyond what they trade on average daily, you would not move the price much at all, because there's arbitrageurs that step in and keep the price in line with the respective price, in this case of coffee, cotton, and sugar, or with the respective index. So your scalability, your liquidity, so to speak, is quite massive as a result of any of these ETFs.
So they just issue more shares, and that's pretty much the situation with the SLV. They buy more physical silver and issue more shares.
Right.
So there really isn't, the fact that it trades 61,000 shares a day isn't really a factor. You just move in and buy it there. But I would say intraday, though, it will move around on the basis of the fact that there aren't a lot of shares trading at any given price point. So there is a little bit of volatility there, but I think in terms of the general trend, it's not something to necessarily be concerned with, because it will just track the prices of the commodities that make it up, which are coffee,
cotton,
corn,
and sugar. No corn. There's no
Not corn.
coffee,
Coffee,
cotton,
cotton,
and sugar.
and sugar. Okay, so I get that wrong. I always keep confusing corn with that, but that would be in the DBC, which is actually acting a lot better. And I think I would
Right.
favor this. I would favor this over the JJS just because it is broader. Now, don't forget about USO, and I think USO makes a good part. Makes up a good part of the DBC, I believe, and that's why the patterns are similar.
It's DBA. You could pull that one up, and that corn is 13% of that.
Yeah, and so you can see that these softs are probably dragging this down, whereas the DBC, which is more oil, and it gives you other commodities as well. I think it's oil and metals, but I think
it's mostly oil, gasoline, and a little bit of gold.
Yeah. So let's cover some stocks that people are asking about. We've gone over all the metals till we're blue in the face. I don't know. I'm a little green in the face. Maybe you're blue in the face. Okay. Where are you, anyways, right now?
I am in Vienna at the moment, and
Okay,
I just had a meeting with the former head of the Austrian Central Bank. So it's been an interesting trip so far, and I'm just sitting here in my hotel room on broadband.
Cool. And it seems like it works pretty well in Vienna.
Yeah, pretty much everywhere. It worked well in Kefalonia, so if it works well in Kefalonia, it should work most first world places.
Have you had any Vienna sausages?
I've had Vienna coffee, which is lovely.
Excellent. Okay, ULT. This is cloud play. This is actually mentioned, I believe, favorably in IBD yesterday. They did a whole thing on the whole cloud space and talked about CRM in there as well. But you have a breakout here. It's kind of funky little cup with a handle. It's a volatile, thinner stock. It trades about 176,000, 77,000 shares a day. So it's pretty minimal in terms of the volume. And so, it's a thinner stock. It's breaking out and it's holding the top of the breakout. That's fine. Other than that, nothing exciting. POT. You notice that this kind of looks a little bit like this and also a little bit like this. So not really clear here. The idea, I guess, is that what do you think of the fertilizers here, Dr. K?
Wait, which it's not coming up on my screen. Which ticker is it?
POT, potash.
All right, I'm gonna bring that up on my own screen here. Yeah, well, okay, so it doesn't look too good to me. I mean, it had a pretty steep correction and then a somewhat tepid recovery. It's a commodity, but the pattern makes me quite uncomfortable.
Somebody just asked a question about QE or thoughts for it ending early or ending later. I think you better watch out for more QE and different, maybe other ways of invoking QE. I don't necessarily see that you can count on it ending. I think if it was going to end in June, the market would be telling you that, given that we're only about 2 to 3 months away from that. And so we're just going to go with the price volume action of the market, understanding also that when the market looks pretty weak, QE can come in and straighten things out and continue the trend. So QE can be the basis for the trend, and so all you need to do is watch the trend itself, rather than trying to anticipate when the trend will end based on when you think the effects of QE2 will end. Any thoughts there, Dr. K?
Yeah, the market anticipates QE2 is still alive and well. And you can even see it in the intraday action at times coming into the market and supporting it. And as far as the macro explanation, I just see the Fed as continuing to devalue the dollar. I don't see how it has much choice other than to continue to do that. So it's going to find ways to do that. And QE seems to be the most viable vehicle. And if not through QE, then other means. So as long as the dollar continues to drop, that's good for hard assets, such as commodities.
Right. Someone's asking about open text. We actually put this out earlier today. It was to me, this was close enough to the 10-day to be a pocket pivot, but it's just a breakout, and you're breaking out to this range. Nice shakeout here off the 50-day, and boom, you're up to the upside. It's a little thinner stock, trades about 384,000 shares a day, but the breakout's fine, and you use the breakout as your guide for a stock. So I wonder if we're supposed to tell you where it's going, but I don't really know. For now, it looks like it wants to go higher. You have this huge gap up here, so of course a lot of buying, but it's a thinner stock, so it's going to violate and pull back to the 50-day, which seems like a reasonable guide here. and now you've come up to new highs. So it looks okay, but this thing could pull back into 60. I guess you could add to it there as long as it held the breakout level, which looks to be about 59 and a half, somewhere around there, 59.50. Other stock, INFA, there's another breakout and pulling back. So not really anything to talk about there other than the fact that you have a breakout and it's up and out and pulling back today. You know, we like AutoZone. I forgot to mention that we put AutoZone in the portfolio simulator. With the price of oil going up and just things getting expensive for people, I think doing your own auto repair, your own maintenance, whatever, changing oil. I can remember in the old days in my 20s when I used to change the oil in my Dodge Colt and trying to save money instead of going to the Jiffy Lube. But you break out here. You actually had a pocket pivot move on the breakout. There was even this sort of pocket pivot right here, but it didn't clear the 10-day. It did clear the 20-day, but we don't necessarily use that. Stock breaks out here, pulls back. Volume is light on the pullback, and it comes in. Now somebody asked, this thing trades 395,000 shares a day, and they asked if it's too thin. But you also have to look at dollar volume. Remember, this is a $273 stock, so if it trades about 395,000 shares a day, if you do the math, you're looking at a daily dollar volume of about $107 million, which is well above my minimum of around $40 million at least in daily dollar volume. So you also have to consider for a high-priced stock at $270 times the average daily volume. That's a lot of dollar volume, so that's a big enough stock. And I think AutoZone has a potential to move higher from here, so that's why we have a 12.5% position in the portfolio similar. I actually did forget to mention that earlier. Look at some other stocks here.
Philip AH. Someone asked about AH. And that one looks great. I mean, it's too extended, but if you own it, keep holding it. Fundamentals are not, it's got some strange thing with the earnings. So the fundamentals are on the earnings side are less than ideal. But on a price volume level, if you happen to own this thing, it looks to me like it's just going to keep heading on higher. And it had a huge pocket pivot day 2 days ago. So it looks okay to me.
Yeah, you had this big pocket pivot. This was a secondary offering that was priced, and so the market absorbed it pretty well, and you had a continuation pocket pivot here. This is actually one that they were talking about this weekend. I was at the High Growth Stock Investor Software Workshop, hanging out with my friends Ron Brown and Ian Woodward, that some of you may know. Great guys, and so we were talking about this stock, and we were talking about Patterson Energy, which also had a little pocket pivot here on Friday, right here. This company is a ground or land driller, and they are actually exploiting the Bakken shale deposits that are in Idaho, and there's a major deposit of oil there, and so they're starting to be able to capitalize on extracting it. So you have a pocket pivot here on a continuation. This thing moved up sharply and looks okay here. Oil stocks are very volatile, though. So it can be dicey, but you have to sit through some volatility. But that said, you have Halliburton moved to new highs, and we've liked Halliburton. Broke out, pulled back to the 50, held, and now is moving to new highs. Baker Hughes has done the same exact thing. So these look constructive. Concho Resources I was looking at earlier. Maybe this tries to come out. The volume pattern here is less favorable. There's a lot of red volume. So I'd also be looking at coals. We did actually look at info. Somebody's asking a question about that. We did just look at it, so you can always review that on the replay when we put that up. But I noticed that you had YZ Yangzhou coal, which is a Chinese coal producer, broke out of this really volatile base. But I'd be looking also for Arch Coal, and that brings up Walter Energy. Not sure what there goes. Something happened. Which is coming up. But see, this is a tough pattern to hold. Look at these shakes, breaks and shakes, and it tries to rally, breaks down here, turning around and coming up. So this is a much more difficult one to hold. But they all tend to be a little bit volatile. But coal may be something to be looking at as well. especially these if they break out, but they tend to be pretty volatile and very, very funky patterns, similar to what you often see in CLF. You know, it did a lot of this before having a nice move, but that's a very choppy move. So resource stocks can be that way. And that includes oils, that includes some metals. Rats. Whoops. Yes?
I was going to say, after this one, take a look at PPO. That one came up also in the form of a question.
Mm-hmm. Rex is trying to break out of its little base. So today was a pocket pivot type of volume signature. PPO, Polypore is another one.
Yeah, that one had a gap up a few weeks ago, which good gap up, pulled back to the 50-day constructively. The earnings decelerated in the last quarter. Outside of that issue, you know, the pattern looks okay. I mean, it did have a gap down on the March 18th, so that's not so good. That was the highest volume day since then. So I would be cautious with this one. If you're sitting in a position, then you could sit and hold it at this level, but I'm not sure I'd be real crazy about initiating a position at this level.
Right. Open table is a thin stock. Got a big move. Once IBD had an article about it. I actually use these guys for my reservations, and what they're starting to do now is have their service on phones, and they're actually doing real-time or call-in type of reservations where somebody can use their service to just find a restaurant and get a reservation instantly and show up, which seems to be favorable. You had a pocket pivot right here, which we did flag, right, Dr. K?
I believe we did.
Yeah, and so you're up and out of here, a little pullback today. Volume was above average, but you closed above mid-range. Nothing wrong there. It's acting fine. Open. Everybody's asking about open. Oh, that's right. The Bakken is in North Dakota, I believe. It's probably an oil guy out there. What's this one? Gulfport Energy. Well, it's up there. So we don't have any crystal ball to tell you what it's going to do from here, but it's acted strongly. NXPI actually had a pocket pivot type of move here. Big volume, big shake, big move to the upside. This actually didn't quite qualify, I believe, here. What was your volume here on this day? 1,904, and here you traded 1,909. Nope, not enough for a pocket pivot here, but this moved up.
Just barely misses it.
Yeah, it's kind of V-shaped, but it's acting okay. So looking okay. Riverbed started to look ugly last week, and it hasn't really gotten back above its 50-day. It doesn't mean that it won't sit here and build a base. You know, a lot of stocks can do that, and just because they pull back doesn't mean they're done. Could spend some time building a base, and you have to remember we first flagged Riverbed when it broke out here, and we got the pocket pivot here, and then there's another pocket pivot in here, and we caught this one pretty early for those of you who've been with us since August, September of last year, and Riverbed has just continued higher there. Now you've gotten into quite a move here, where the stock's more than doubled, and now you're spending some time possibly building a new base. So, that may build a new base. We can't tell you where it's going from here because we don't have a crystal ball. Thoughts on Travelzoo? It's a thin stock, and it's gone up a long way. So there's nothing else there. I always find it interesting that people think that it's something that's gone up a lot that they can ask us, like, we know if it's going to pull back or go higher. You don't, you have no idea, and I pawned my crystal ball off for a new guitar, so I don't have mine. I think Dr. K pawned his off for a new piano, but that's just got a lot of power. It's a thinner stock, but when you think about Priceline is doing well, similar area. I think Expedia has also, forget Expedia. I guess they're the ones who are getting creamed by Travelzoo and Priceline. I don't think it's surprising to see another stock moving along with Priceline. So TZU looks great. I guess I wish I owned it, but it's a little bit thin for my blood. We talked about Fortinet at the beginning, so I would say that anybody asking questions about stocks you've already covered, we'll just advise you to read, or not read, but actually view the video when we put it up on the website later. Polycom acts okay. Here's a situation where you had a pocket pivot kind of breakout here, and it closes in the lower end, okay, and then it comes in like Oracle is doing now, and then it turns right, goes higher. So it's acting okay. Not a lot of volume today on the upside. BEXP, that's probably what Brigham Exploration, I think it is. It's an oil. V-shaped kind of recovery. So nothing really. There's nothing that sticks out there. How about on your end, Dr. K?
1 second, it's just coming up on my screen. Somehow it's delayed. So yeah, we had a, well, it looks like we had a pocket pivot a few days ago. I don't know, it's about a mid-bar close. But, you know, it's an oil stock, so it's going to trade a bit sloppy.
Mm-hmm.
And, you know, if you're sitting in it, great, just hold on, hang tight. But, you know, expect it to trade in a bit of a sloppy manner as is wont to for many of these types of commodities.
Somebody's asking about Netflix being a late-stage base. Dr. K, you want to comment on that?
Well, as far as late-stage basis, we really don't put a lot of weighting into that, because ultimately, if a stock is breaking out of the fourth stage base, third, fifth stage, there are stocks that just they don't care that they're breaking out of a fourth stage base. I mean, statistically speaking, if you want to reduce it to statistics, yes, stocks have a certain most stocks will not get to a fourth or fifth stage breakout, and if they do, you know, some stocks are going to work. They're going to keep on going. In fact, that might be the point at which they have their big climax top. So you don't want to really put too much credence in this, you know, third, fourth, fifth stage business. It's far better to analyze the price volume action going on in the base that in which the stock breaks out. In fact, there was a stock, I think it was Taser, although that might have only been a third stage breakout, but the stock had a huge, massive move from its original base breakout to the last base. I think we're talking, I mean, just an insanely huge move, like maybe 40-fold or more. So on that last, I remember that last base that formed, and it wasn't very long. It was a number of weeks, and it broke out of that. It was a tight constructive formation, and I remember seeing that, and I thought, well, the stock is just so far up. It seems like it's a bit too risky to play up here, and it doubled from that breakout in a matter of just a few weeks. So you know, you really don't want to let stages keep you out of the stock, or the fact that the stock has risen, you know, 40-fold.
The other thing you might consider about Netflix is, where is the first stage base? Is this first stage, second stage, third stage, fourth stage, fifth? I don't know. Where do you start to get worried? You know, I think you just let the stock tell you instead of trying to anticipate it. I think people put too much emphasis on this concept of late stage bases. You just go with the price volume action, and as long as it continues to work, you stay with it. And like Dr. K was saying, a lot of times you can get a climax top and you end up missing that because you're too fixated on whether it's a late stage base. So some esoteric jazz just keeps going up. So there's nothing really going on there. I think people just want to brag. That's all. Jazz is about jazz because it just keeps going higher. And there's really nothing there that looks bad. It just keeps going higher. You just missed the pocket pivot, continuation pocket pivot today, I believe. But you're a little above the 10-day, so you're kind of extended, but it just keeps going higher. Now, jazz, I think, is an interesting story, because back when the stock was in here and we were talking about it, I was getting emails from somebody who was telling me that their brother-in-law or somebody they know who works for a competitor of Jazz had a whole story on why their drugs are crummy and they're not going to be selling, and they're pretty much done. But you know, the way I look at it, a drug salesman, whatever he knows is either already in the stock or it just isn't true. Especially if it's a competitor, because it's clear that if you listen to stories like that, or you listen to somebody, unless they're the CEO of the company, the CFO, and they're not going to be telling you anything. It's usually the ones who are talking the most are the guys maybe who have a stake in talking down Jazz. So it would strike me that a salesman from another company that's a competitor of Jazz telling you that the company has problems, he's probably got a stake in that sort of viewpoint. But again, the price volume action tells you everything. You don't ever need to listen to opinions. And I would be very wary whenever you hear somebody tell you something like that they know somebody who works for somebody who is a competitor, and they can tell you everything bad about Jazz. And it's just it's nothing but all that jazz as far as I'm concerned. We talked about NXPI. I think we're kind of running out of time, so save up your questions for next time. You know, right now you got a few ideas that we like, and you can make some progress. It's not necessarily all that easy. The stocks are all over the place some days. There are some continuing leaders, but I think if you went with the buy signal and you're using ETFs, you're probably in a better position to ride this out. We'll just have to see how things go. My guess is, however, that because most people are skeptical of this rally currently, it may end up working. And of course, the crowd seems to know that breadth has not been that strong here, and that may end up fooling everybody. But I do know one thing: you don't really want to be trying to play the short side here. I think you want to be playing it close to the vest and on the long side and picking your shots. And there are some things to be keeping an eye on. And of course, we'll be letting you know when we see pocket pivots in buyable names, as that is usually your best spot. You know, we gave you Open a few days ago, and that thing's moved a lot higher. We gave you Mollycorp, MCP, a few days ago, and that thing has moved a lot higher, about 15, 16, 17% from where we first flagged it. Been a very nice name. Silver's done well. And so I think in general, there's some constructive things going on. It doesn't mean that it's going to be all that easy to make money, and it may mean that we're in a choppy environment going forward. So with that, I'll let Dr. K make any closing comments that he has, and then we'll end it.
Yeah, well, essentially, we're in a QE environment, and as Bill O'Neill always used to tell us, don't fight the Fed, and their QE is quite a formidable force. So I would stay with the trend, and we'll see about Greenspan not Greenspan, but once again. I don't know. Why do I have Greenspan on my mind? You know why? It's because of the name today. Yeah, Vienna. Yeah, just we'll sit and listen to what he has to say in early April regarding the future of QE.
All right, sounds good. All right, anybody, if you have any further questions, you know where you can email us. Thanks for showing up, and we'll catch you next time. We're not sure when we're going to have an intermediate one. One of the problems, though, just to close with this observation, is that sometimes you don't want to start getting into too much commentary and trying to hash things over, say the same thing over and over again in a different way, because it's really not very constructive. And I think it can get you on too short of a time frame. I think the only way you're going to be able to make money in this market, if you choose to play, is by taking it slow and steady and picking your spots. And you'll probably see how we work that in the portfolio simulator to give you some idea how we would handle it in that particular venue. So anyways, good luck, and we'll catch you guys next time. Everyone, take care.
Take care.